Hi, everyone. Welcome to our webinar, Startup Infrastructure 101. Thank you so much for joining us today. Before we begin, just a few quick housekeeping items. This session is being recorded, and a link to the recording will be sent to all attendees after the webinar. If you experience any technical issues during today's session, please feel free to email me directly, and I'll be happy to assist. I will place my email address in the chat just in case. And we encourage you to submit questions throughout the presentation using the Q&A feature. We'll reserve time at the end of the session to address as many questions as possible. Today's session is designed to help startups move from early startup energy to sustainable, scalable growth by building the right infrastructure across tax, finance, benefits, and HR. Our goal is to provide practical guidance and real-world insights to help founders, operators, and leadership teams create scalable systems that support growth, investor readiness, and long-term operational success. With that, we have a fantastic group of experts joining us today from both Sensiba and Alliant. From Alliant, we are joined by Lori Berenstecker, VP and Employee Benefits Consultant, Crystal Calvo, VP and PEO Specialist, and Drew Steinhoff, First VP Human Capital HR Consulting. From Sensiba, we are joined by Cole Marr, Partner in Tax, Kevin Shives, Partner in Consulting, Mimi Wang, CAS Manager in Consulting, and Mian Ta, Senior Manager in Tax. Together, this team will bring deep expertise in supporting startups and high growth companies across financial strategy, tax optimization, HR infrastructure, benefits planning, and compliance readiness. We have a lot to talk about today. So here you'll see for those who may not be familiar with Sensiba, we are a top 75 US public accounting and consulting firm with more than 40 years of experience supporting companies both domestically and internationally. We work with over 10,000 clients across industries and provide services across tax, audit, consulting, governance, risk, and compliance, finance automation and ERP support, sustainability, and ESG consulting. Our teams focus on helping companies build scalable infrastructure while navigating regulatory and investor expectations. We're also proud to partner with Alliant, one of the nation's leading insurance brokerages, known for its forward-thinking employee benefits and risk management solutions. They are the fifth largest insurance company in the nation and the largest privately owned insurance company, with over 5.1 billion in revenue and manage over 47 billion in premiums. They have over 14,000 employees and offices nationwide, and majority employee owned at 51%. Alliant supports organizations nationwide with their deep expertise in employee benefit strategy, PEO advisory, and scalable HR and insurance infrastructure that helps startups support and retain top talent while managing risk and cost effectively. With that, I'm excited to kick things off and turn it over to our first speaker, Crystal Calvo, who will run through our agenda, and then she'll begin discussing 2026 HR trends for startups and the challenges they face. Crystal, I'll hand it over to you.
Thank you, Angela. Hello, everybody. Thank you so much for joining us today. My name is Crystal Calvo. I am the PEO specialist for Alliant Insurance Services, and my primary role is to use my 10 plus years of experience in payroll and PEO consulting at firms like ADP to enable our teams at Alliant and our partners like Sensiba to better service our tech startup clients just like you. I specialize in consulting companies from 2 to 150 employees across the life science, technology, and financial services space. So what we have found throughout our discussions with hundreds of startups is that during the early stages of a company, founders are really forced to move fast, and this often leads to short-term momentum at the expense of culture, compliance, and scalable decision-making. Accounting, tax, payroll, HR, and benefits often get built reactively instead of intentionally. And we are really here today to express the importance of taking time to design fundamental infrastructure across all of these functions. And the startups that take the time to structure these fundamentals early on are the ones that we find are best positioned to grow without friction, surprises, or costly resets later on. So we do have a jam-packed agenda for you all today, and the Alliant and Sensiba teams will be covering key things to know and keep in mind. as you set up your company infrastructure. I'll kick it off with 2026 HR outlook and challenges startups will face. Sensiba will follow with accounting infrastructure, R&D tax credits, qualified small business stock initiatives. We'll pass it over to Alliance Human Capital Management team to discuss HR foundations. We'll discuss benefit offerings and benefit strategies for you as you do scale. And lastly, we'll finish off with what is a PEO and how it can support your organization to scale. So let's dive into the HR outlook for startups in 2026. McKinsey's most recent research study shows that startups that will be ahead of their peers in 2026 aren't just better funded, they are better designed. And the common thread is how founders are going to utilize AI, control people cost, hire globally, and manage risk earlier than ever before. In 2026, we are seeing four key trends. And let's start with the first one being investments in AI first companies. What we are seeing is that capital is flowing to AI native startups that scale with lean teams, and smaller tech enabled teams are expected to outperform larger organizations in the near future. We are also seeing capital discipline is becoming a primary driver of startup valuation. So VCs are demanding profitability and a return on investment earlier in the life cycle, and therefore having predictable people cost and having a pulse on the output of each individual employee are critical to preserving runway. We're also seeing compensation, healthcare, and overall insurance expenses are now board level conversations. We're also seeing a very tight talent market with distributed teams, not only across multiple different states in the United States after COVID, but also globally. And there's a high demand for tech adjacent and AI complementary skills, which continue to outpace the supply in the United States. So not only are startups competing directly for big technology and US specialized skills, that's why we're really seeing a rise of remote and global hiring across all startup ecosystem, which does have its limitations, and those limitations are related to the risk associated with having a global workforce. That gives us a good segue into cybersecurity and risk mitigation. Nearly 80% of cyber incidents involve human error, and with distributed teams, this could increase data security challenges. So it's really important to take a look at proactive HR and insurance policies to reduce these potential fines, breaches, and potentially reputational damage. So overall, these trends aren't isolated. They're actually all interconnected. AI investment influence talent needs. Capital discipline drives how compensation benefits are structured. Talent scarcity forces global workforce strategies, and cybersecurity risk becomes a people challenge and not a technology challenge. So we discussed some of the challenges that a startup will face, but every founder starts with the same priorities, and those are to build a great product, to grow your revenue, to gain customers, raise capital, and hire great people. But the reality is that's not where the time is going. The challenge really isn't knowing what matters, it's what's pulling you away from what matters. So when we look at where your time actually does go, it goes into these main areas of compliance, recruitment, and endless budgeting meetings. So not only are you competing with larger organizations on talent, you're having to balance cash, equity, benefits. You're trying to build something scalable without overcommitting too early. And the McKinsey study found that it is true. 25 to 40% of your time is on people management and administrative work instead of your core company's priorities. So overall, the real challenge isn't your ambition, it's the bandwidth that you have. And the companies that tend to scale the fastest are the ones that are intentional in removing the friction around people, compliance, and administration. Removing the friction means putting the right infrastructure and outsourcing strategies in place early so that people, compliance, and costs scale without consuming your time. A lot of our presentation today is going to be discussing strategies and tools to do just that. right? Reduce your time and help outsourcing. So I'll pass it over to Kevin to discuss how to remove friction in your accounting infrastructure.
All right. Thank you very much, Crystal. Hi, everyone. My name's Kevin Shives. I'm a partner with Sensiba in the consulting group. My primary role is leveraging my 25 plus years of experience in accounting and finance to help our teams provide the highest level of service to our tech startup clients. Today, I'm going to focus on accounting and finance infrastructure that startups need for success. I hope your takeaways from my short talk will include starting early. Founders need real accounting solutions earlier than ever before. Knowing the elements of accounting and finance that you need for your startup. What does it actually look like? How do you evaluate a potential accounting solution and getting what you need without spending too much too early? So that evaluation, very important. This isn't about adding overhead. It's about founders having the systems and processes they need to stay focused on growth while knowing that their financial foundation can support what's coming next. Next slide, please. One up. There you go. Most founders think accounting becomes important later in their company's evolution. Maybe they're waiting for a certain level of revenue or funding. Understandable, but these delays can lead to serious issues. The most common case I see is a founder will spin up QuickBooks Online, connect their bank account, maybe an expense and bill pay system, and they're off and running. This is a good start, but unless you really understand the proper transaction coding, the accounting close, and how to reconcile accounts, you quickly find yourself with a hodgepodge of information that you don't have much confidence in. And then at year end, you're spending extra money and time helping your tax accountant sort through it all. I'll talk more about this a little later, but the big change in the market in recent years is that you can right size your accounting solution and related cost as you grow. This allows for very low cost entry points for accounting and finance services. Early decisions around systems, process, reporting, and compliance compound quickly. Weak infrastructure doesn't usually fail loudly, it fails quietly while draining time, cash, and most importantly, investor credibility when you need it the most. Next. What are the primary challenges in this area and how are they best addressed? So you find yourself leading a startup. You have books, so you need an accountant. The obvious approach is to go hire one. In-house talent, even if you can find an accountant to hire full-time, they will be very expensive. They'll add another person for you to manage. And ultimately, they will likely lack the cross-disciplinary experience that is really needed in a startup environment. An example, perhaps your new in-house accountant is great at bookkeeping, but they don't quite understand the sales operation overlap and system integration requirements. This will create a lot of friction downstream. It will affect your billing, your cash collection, reporting, and much more. It is actually a very rare individual that possesses the depth and breadth of experience needed to support a startup cross-functionally, at least one you can afford. When I meet founders looking for help, they have generally spent several cycles trying to balance their focus between their product development and their need for investor-grade reporting. And this pressure just compounds as they find that second gear and start to grow. Now it's not just about bookkeeping, it's about, can you forecast your revenue, your cash requirements? All this becomes very critical. Not having a good handle on this aspect of your business will affect your fundraising and all your decision making. Next. Growth is obviously the name of the game. And when it happens, the strain on your back office just gets heavier. Revenue is not predictable. Compliance requirements increase. And today, investors expect founders to have a higher level of financial acuity earlier in the process than ever. And thus there's very little patience for messy books, compliance issues, and unclear metrics. Next. Next, there you go. So I've covered some of the high-level challenges that most startups face with their back office accounting. How do we see these challenges best addressed? Most commonly, the best answer for early stage startup companies is embracing a client accounting services model, CAS for short. Basically, this is where you're outsourcing your accounting infrastructure to a firm. The reason this is most successful is because it provides founders with the access to the talent and tools required at all levels, starting with day one. I've listed on this slide some key foundational attributes that the right CAS firm can bring to your organization. This is what strong accounting solution looks like. Once you decide that CAS is right for your situation, the next question becomes, how do you choose the right firm? What's best for you? Next slide. Okay, CAS isn't new. It's been around for decades, and there are many, many firms' choices. However, not all CAS providers understand startups. Having an approach for selecting the right CAS partner is critical. I've listed on this slide some of the key considerations you should evaluate in your search. The right experience, proven startup experience. You want a navigator in this journey, someone that looks forward, around the bend, that knows the challenges your tech startup is going to encounter along the way and helps you and guides you before you get there. Scalable systems. New accounting and finance technology with AI for your tech startup is hitting the market at a dizzying pace. The time and focus needed to properly evaluate your best fit tech can be significant. Misaligned choices will be expensive. You need to partner with someone who understands this landscape and has pre-selected the latest and best tech stack that will serve you now and as you scale your business. Let's face it, you need it all. Transactional processing, this is all the basic blocking and tackling of accounting and strategy. Most CAS partners claim to have the deep experience and ability to provide that strategic guidance, but they're mostly focused on the transactional accounting and not really able to pivot to the strategic when you need it the most. I recommend drilling down here. Ask to meet the person or persons who will advise the strategic needs of your business. Ask them about dynamic financial models and forecast that help clarify timing and manage your cash runway, help you make strategic decisions, support you in fundraising efforts, and enable scenario planning for different growth trajectories. If you get a deer in headlights response to these inquiries, then you probably need to keep looking. And also understand the total capabilities of the firm you're considering. Having a solution partner that includes CAS, technology, and tax, in other words, a full service organization, this can create great efficiency in communication and cost. For example, at the end of the year, the tax team works directly with the CAS team to get your accounting data, and this kind of takes you out of that chore, that task. And don't forget pricing, of course. The best CAS pricing model acknowledges the reality of your startup situation. Subscription models that allow you to layer on services as you scale can be an excellent way to control costs while getting the service level you need. The key to finding a partner is find one that understands startups for sure, where you're currently at in your evolution, and can do all this, help you scale without forcing you for premature cost and complexity. Next slide. Okay, so choosing the right CAS partner is obviously very important. It's not just about finding a bookkeeper. It's about finding a solution that will help you move faster with fewer surprises. Strong financial infrastructure reduces risk, speeds fundraising, and lets leadership focus on growth instead of administrative matters. So remember the key points. Get help earlier than you're probably thinking. Remind yourself of the key elements of startup accounting infrastructure, what it looks like, and have a plan to evaluate any potential partners. My contact info will be sent to everyone registered today. Please don't hesitate to reach out with any questions. I'm always happy to be a sounding board on this topic without any obligation. Now I'll turn it over to my partner, Cole, to hit on the R&D credit opportunity for startups. All yours, Cole.
Thanks, Kevin. Excited to be here to cover two pretty tactical things with you that I think can be meaningful right away for your business and things that you need to have on your radar from the very beginning in most cases. So the first one is the R&D tax credit. So some of you might be thinking, well, it's a tax credit, I'm not paying tax because we don't have taxable income yet. But on the next slide, we'll highlight why it is an opportunity for startups. So startups specifically are eligible to potentially use this credit to offset payroll tax. So as long as you have employees, you're paying payroll tax at some level. So taking a step back, this credit is a general business credit meant to reward innovation with an impact of between 10 and 20% of eligible expenses back to the business. So if you're a qualified small business, as defined by Congress, but most people would say the IRS, in this context, the R&D credit that you generate, you could be eligible to elect to take at least $500,000 of that federal R&D credit and offset payroll tax. So the way a company roughly classifies as a qualified small business, and as with all things tax, there are a few caveats here, but the basic way to think about it is that if you are a startup in your first 5 taxable periods, or think of it as years in most cases, with no gross receipts in the prior 5 taxable periods, so think 5 years and $5 million in gross receipts in each individual year, meaning if you're in year 3 of eligibility and your revenue pops up above $5 million, you're no longer eligible for that year in question. But then the next year, if you're still within that 5 taxable period time frame and your revenue drops down below the $5 million threshold, you may be eligible to elect this payroll tax offset again. So the way I like to think about this is that, the credit that you generate, you're offsetting the employer side of Social Security and Medicare tax. So you're slowing your wage burn rate down by 7.65%. That 7.65% that you're remitting, every pay period, whatever that is, right? You can keep that in your business potentially. So there's several ways that payroll companies enable your usage of this credit. But some have real-time usage, some make you wait till the end of the quarter, but it is a relatively quick and impactful way to keep some money back in your business. The next slide. There's a general overview of the credit, right? Once you're talking about how you may be able to benefit from it, we're talking about new or improved products or processes. They don't have to be revolutionary to the world. They can just be evolutionary to your business. A lot of times with startups, it is things that are revolutionary, but they don't have to be. Congress has set out what they call the 4-part test. So if you're talking to anybody about the R&D credit or hear anything about it, you always hear about the 4-part test. And that's because this credit is a pretty generalized incentive. It's not super targeted at any specific industry or company or anything like that. As long as you can make the case that your company qualifies and do the things that you need to do, qualify the projects, quantify the expenses, and then calculate it and get it on the tax return, you can claim the credit. So these expenses that go into it, right, when we talk about getting 10 to 20% of your R&D expenses back are things like wages. So pretty good footprint. So not just direct conduct, not just developers or scientists, but also people supporting those projects, QA people, testers, the full footprint of what you might consider R&D. And then supplies consumed, which can now include cloud computing. Technically, it's computer rental and it's a 4th expense, but that's a really wonky tax thing that you don't need to think about. But cloud computing expenses are obviously escalating rapidly, and so many of our clients that didn't have a significant expense in this category before now do. And then contract research. So resources, experts outside of your company that might be contributing, that you're engaging in to help you with the R&D process in many different respects. Those expenses can be included in the bucket of things that can help generate the credit. So then on the next slide, we just want to touch on real quickly the four-part test. I won't even walk through all the pieces, but when I mention four-part test, because this is what I've been doing my entire professional career, I just have to add the four-part test in here so people can see it and see what just the general, though somewhat vague, guidelines are for the R&D credit. So that was a quick flyby of the R&D credit. Now we're going to move on to Section 1202 stock. Qualified small business stock, it is also called. We'll get through that real quick. Going to the next slide. What is QSBS, right? That's the shorthand for qualified small business stock, Section 1202. It allows non-corporate taxpayers to exclude a portion of the gain, of the sale of a qualified small business or qualified small business stock. So this is a tax treatment that's been around for a long time, though there have been some recent changes, and my slides will reflect those recent changes. It's really meant to encourage investment in startups. We're going to think of it, small C corporations, by allowing shareholders to exclude some of that taxable income upon sale. So in the next slide, we'll talk about the core eligibility requirements. There are a lot of details, but the reason we want to bring this to your attention in this startup presentation is that it's something that needs to be on your radar. Maybe you're not an expert about, but you should talk to your advisor. You need to make sure that you're protecting your investors, protecting yourself as an investor in your startup likely, but protecting the investors that you bring on. So the core eligibility requirements are that the stock just needs to be of a domestic C corporation. The stock needs to be acquired at original issuance. So if you've acquired the stock in some way on a secondary market, you will not be able to receive QSBS treatment. The company needs to be a qualified small business. Kind of sounds obvious. It's a little bit recursive there, but qualified small business. And an important thing to remember is that the business, in order to protect your QSBS status, it needs to be an active trade or business. Something that we see a lot, especially in the medical industry, is that companies, as they move in and out of different phases, maybe they're move in and out of funding or not, will mothball companies or entities for months, sometimes years at a time. And that counts against this active trade or business test. So you need to be actively engaging in the business and maintain your minimum holding period. We'll talk about on the next slide, and meet the gross assets threshold. That gross assets threshold is now $75 million. That's one of the updates as of 2026. It'll now be inflation adjusted, which is nice. So once you pop up over the $75 million gross assets threshold, important to note that the stock that was acquired before you violated the threshold still receives qualified small business stock treatment. It's just subsequent rounds, subsequent investors, which will no longer be able to qualify for the qualified small business stock treatment. So the tiered gain exclusion, you only have to hold the stock for 3 years before you get some preferential treatment. It's stair-stepped up now, 50%, 75, and then 100% if you hold it after 5 years or more. If you heard about this previously, it was an all or nothing approach. You either held it for 5 years, got 100% exclusion on a certain amount, or nothing. So this step up is a nice improvement to this qualified small business stock category. And then I also mentioned on here a per issuer gain exclusion. Again, that's one of those really down in the weeds things, and then one of the reasons why you need to be managing this from the beginning, but not a key point here. So with that, I think I'll go ahead and throw it over to Drew. He's going to cover how to hire and structure your people in a way that helps you scale and grow more efficiently. So thanks, everybody.
Perfect. Thank you, Cole. Hi, everyone. So my name is Drew Steinhoff. I'm part of Alliant's human capital practice. Just quick bit of background about me. I've been in the total rewards human capital spaces for about 20 years. Half of that has been on the corporate side, and then the other half was on the consulting side. And in my role, I partner with lots of different types of companies, but have a kind of a specific concentration in these startup environments. So, really excited to talk with you all today and share my perspective on some of the, unique challenges and opportunities that come with startup environments. So if we want to go to the next slide, um, so when I partner with companies in these startup environments, really, I would say there's a couple main things that I do, and the first starts with developing a job framework as well as a equity strategy, and important to recognize that what you're building, you're not building it just for today, but you're building it for the future as well. With all of the growth projections you often have from a hiring perspective, it's important to think about, where you want to be in the future and what you should build now to be able to accommodate for that future. Because at the end of the day, as this slide says, people are really an organization's most valuable asset. And so, with that, and you see it at the top here talking about compliance, which is, I know, not the sexiest of things to talk about, but I'd be remiss if we didn't acknowledge it and we didn't talk about it. Compliance regulations are always evolving. They vary based on states, even local sometimes. So it's important to have your hands around and be mindful of things such as, exempt versus non-exempt classifications, contractors versus employees, major U.S. regulations that we've noted a few here, but important to have familiarity with these things as you think about building the organization. But also, as we think about that hiring, it's important to have a really strong job framework. Again, not just for today, but for the future. This framework will do things around titling nomenclature, creating definitions of what it means to operate at each level of work, so that as you grow and building this framework for the future, so as you grow, you will be able to fold in people. You will be able to be, your framework will be flexible, and will be able to adapt with you as your organization grows. But as we think more broadly, kind of at that people strategy, it's important to recognize that your talent pool for startups all often looks very different from your talent pool at more mature organizations. Startups, there's more uncertainty. So really the people you're looking for are generally going to be more entrepreneurial, risk reward, comfortable operating in the gray with less autonomy. And obviously with smaller headcounts in these environments, as you all know, a bad hire can have very, harsh impacts on an organization. So the importance of getting it right and the importance of finding the talent that will fit within these startup environments is really important. And to do that, also important to be able to articulate your total rewards strategy, your total rewards package, which again often looks very different from more established companies. Being able to talk about equity, performance-based awards, things that can be true wealth generators in these startup environments under the right circumstances. So being able to fully articulate how employees can contribute to this success and how, as the organization becomes successful, things around your total rewards package can continue to grow as well. But total rewards is just one piece, an important piece, but one piece of what we call the overall employee value proposition, or really the full picture of what the company is providing and how it's investing in the employees. So if we go to the next slide, this is what we have that really speaks to the employee value proposition. And the reality is a strong employee value proposition isn't just good for employees, but there has been lots and lots of proven research that speaks to how a strong employee value proposition fosters an engaged workforce and how strong engagement correlates with strong business results. So this pyramid here may look to you like Maslow's hierarchy of needs, if you recall from your science classes, but really speaks to this bottom rung here, this wallet, is your foundational pieces. And this idea is you need to satisfy each of the lower rungs in order to kind of unlock and move to the next one, and then unlock and move to the next one. So, at the bottom, we have the wallet, compensation, retirement, financial well-being, benefits, foundational pieces that are core to an employee. So it's important to have strong philosophies on those and develop those designs. But then once those are satisfied, then employees are going to start to look towards the head or look towards career pathing opportunity, mentorship, development opportunities, and other ways that you're investing in the employees. So this gets back to the importance of having a strong career framework in place to be able to articulate to employees how they can advance and grow in the organization. And then once that head is satisfied, then you can look to the heart, or the ability for the employee to feel alignment with the organization and truly find meaning in their work and get that true engagement. So once we see that truly engaged workforce, as you see on the right, again, time and time again, research has shown that strong engagement results have meaningful impacts on productivity, profitability, turnover, and all things that are obviously really important to the organization. So wanted to share that with you around the importance of the employee value proposition and the importance of being able to effectively articulate that to your employees. So now I'm going to turn it over to talk about another piece of the wallet, the benefits, and I'll turn it over to Lori. Lori, you may be on mute. I can't hear you.
I certainly was, Drew. Thank you.
Perfect.
Thanks for the introduction. I'm Lori Baron-Stucker, an employee benefits broker and consultant for small and large group employers. And I've been doing this for about 16 years. That is medical insurance consulting. Benefits, they can not only just be of top concern for your employees, but also one of the top expenses in your budget. So it's really important for you to understand what your options are and a little bit about benchmarking as well. So first, let's take a look at some benchmark data. The table that we're showing here came from Alliant's 2025 Tech Benefits and Perks Survey. And it shows commonly offered benefits at three different sizes of companies, three different levels. When you first start implementing benefits, it's important to think about long-term sustainability. And one of the common mistakes I have seen with small companies as they launch their benefits is being overly generous, trying to compete with the big companies and using benefits as a draw. But you really want to make sure you're doing this in a way that is sustainable and you'll be able to grow it as you grow in size. And one thing to know is as you grow in size, benefits do become more expensive. So it's really important to think about sustainability and possibly being a little bit more conservative whenever you start your benefits program. So as shown here, companies with fewer than 250 employees typically focus on the core benefits, and that's just your medical, dental, vision, life, and disability. And then once you start growing beyond 250, that's when we see companies start layering in more options, such as the mental health, fertility, matching your 401k. So let's talk about the different options that you have as a small business. And I'm really going to focus on the light blue boxes here. The darker blue are for the larger companies, like you see here, self-insured with a captive. That's typically, you start seeing that as an option when you're over 100 employees, and then going self-funded directly when you're 700. But backing up to where a small company might be better suited. The exchanges have been around for a while now, but because of some policy changes, there are more limitations with the exchanges. One of the best ones is Cover California, that shop. And then Another option that you might not have heard too much about is ICHRA. And ICHRA, that stands for Individual Covered Health Reimbursement Arrangements. That's been around only since about 2020 and is another way to have to offer medical benefits to your employees. Not really well adopted just yet. So for that reason, I'm going to stick to the right side of the chart here, which is direct with carriers. Well, that is using a broker. That can be for fully insured plans or level funded, or the PEO option, which when we get to that, I'm going to pass it off to Crystal for a little bit more explanation on that. Okay, so there are some important things that I want you to know about going direct with the carriers, using a broker, things like that. As a small business, you really need to understand these things that I'm going to tell you, because this can make a big differentiator as to what you choose to do as far as benefits go. So first, let's talk about the small group definition. Most states do consider small groups to be between 1 and 50 employees. In California, which is where we are, California's definition of small group is 1 to 100. And then large group, you can see what that definition is over on the right side, but we're focusing primarily on the left side here. This next bullet is really quite important for you to understand, and that is that a carrier will not underwrite your group if more than 51% of eligible employees are outside of the state of California. So we're focusing again on a California rule here. So that could be a really big deal, especially post-COVID. We see that workforces are distributed across the United States. So if that's the case with your company and the majority are outside of the state of California, then you might want to look into something like the PEO or some of these other options. One other thing that is also something important to know is how the premiums are structured. So in small group, you have member level rated premiums. And in small group plans, they are book rates. The rates are the rates. Every broker gives you the same rates when you're working with a small group, those types of options. And so here we have a gold plan example, a gold PPO. And like I said, it's based on every individual member's age. So the employee is 45. So you see what that person's rate is, and then spouse, child 1, child 2, etc. So you add up all of the rates for each one of these family members, and you get the total premium for the family, which is $2,889. Now let's flip that to the other side just really quickly to compare with large group definition here and how the premiums are structured. So here it's composite rated, which is what you may have been familiar if you're with any large company. This is typically how you see the premiums. An employee only is $890. You can see the spouse there. A big difference here is for children, employee plus children. You can have as many children as you have. It can be certainly one child, it can be 10 children. And it's the same is true with employee plus family. You just have one set rate. So those are some key things that I wanted to point out there. And let's see, sorry about that. I think if you take these things into consideration, you can decide like if member level rating is good for your company, and it can be if you have a younger demographic, then these rates can be a lot lower. If you have an older demographic, well, then it might not be quite as advantageous because the older the employee is and the higher the premium is. So that is one of the things I'll lead into with the PEOs is you can get into the composite rates, and I will turn it over to Crystal to explain a little bit more about PEOs and how that works.
Thank you, Lori, for teeing me up. So let's chat about PEO, how it can help you scale, but also how you can leverage the purchasing power that they have with insurance carriers to potentially provide more of a Fortune 100 level feel for your organization. Next slide. Perfect. So let's start with the acronym. What does PEO stand for? PEO stands for Professional Employer Organization, and a PEO is a co-employment model where you, a startup, leverages the federal ID number of a PEO like ADP, TriNet, JustWorks, Rippling, to name a few that you've probably heard of. And most of the organizations that are leveraging a PEO are between 2 to 150 employees. There's definitely larger organizations that leverage a PEO, but I would say the bread and butter is between that 2 and 150 employee space. What we're seeing over here to the left is every one of these boxes represents a decision, a risk, or a distraction pulled onto founders' plates. To name a few, we have onboarding, compliance, I-9s, safety audits, and none of these over here to the left are revenue generating. Every single one is a time allocation for you as the founder, and it also is a risk. And let's be real, nobody really wants to spend time on these items over here. So when we take a look at the PEO industry and the structure and risk alignment that it provides, it's really a one-stop shop where we take some of that risk by having the FEIN number under the PEO so that the PEO can now support and take on the risk associated with payroll administration. This is extremely important if you do have employees in multiple states, because the PEO will do the state filing and provide guidance on local, state, and federal laws there. HR technology will be ran through the PEO. Most of the PEOs that are publicly traded also have their own proprietary technology that they've created. So you eliminate the manual tasks associated with onboarding, recruitment, reporting, benefit administration, or 401k integrations by leveraging a amazing technology system that allows you to scale from 2, 10, 25, 50, 700, 100 employees. And then they also use the purchasing power, which we'll touch on in a little bit on the employee benefits and 401k side. Workers' compensation and EPLI, which is employment practice liability insurance, can also be leveraged through a PEO setup. So it's not only the infrastructure and the risk transfer, it's also people. If you were to, as a 10-person company, hire an HR manager in California or New York, we're looking at anywhere from, $60,000 to $80,000 a year to have somebody internally. A big reason of why small businesses or startups leverage a PEO, about 17% of companies under 100, is because of the people support that it comes with. So should you evaluate the PEO, it would come with an HR consultant, a payroll representative, a risk manager, a technology manager, and then a benefits specialist as well. So according to the National PEO Organization, startups that leverage a PEO grow 2 times faster than companies who don't, because of all of the items that we just touched on. So let's take a look at the PEO landscape in itself. So when we take a look at the PEO landscape, there are about 500 PEOs in the United States today, and PEOs provide services to more than 200,000 small to mid-sized businesses. Remember, we have to have at least 2 employees to be considered a group. They employ approximately 4.5 million people in the United States, which represents about 17% of companies under 100 employees. And 5 PEOs are publicly traded organization, multi-billion-dollar organizations, which when we take a look at their earnings call are expected to grow about 8% year over year. Some of the top PEO contenders, which have about a fourth of the PEO market share, include ADP. Historically, they are a payroll company, and they grow through organic growth, primarily their ADP payroll clients that at some point leverage the PEO for either large group benefits or HR support, technology integrations. Venture HR, they have completed their 100th acquisition this year of smaller PEOs, and they're growing through acquisition. I believe they are now, this chart here is a couple years old, they're now the largest PEO in the United States. TriNet, Insperity. TriNet is a tech-forward PEO with about 300,000 clients. They have many clients within the technology, life science, and within those types of industries. And Insperity is actually the founder of PEOs. They're the first PEO to ever be created. They have a large market share, and JustWorks is really focused on that startup ecosystem as well. Honorable mentions would be Rippling. Rippling has grown significantly within the startup ecosystem in the last couple of years, and then Paychex PEO as well. So all of these PEOs, what they have in common, they own their own technology, which allows you to scale regardless of your size. Great. And, medical is going to be a big trigger event to take a look at a PEO solution. Lori was alluding to it earlier, but especially in states like California or New York, where you are either age banded or community rated, if you have less than 100 employees, we find those states tend to have the largest PEO market share. So I wanted to give an example, and this is an example of a 20-person organization out of New York City. We did an analysis for them here at Alliant. We partner with about 12 PEOs, and we took a look at the medical for ADP Total Source, Extensus, TriNet, and Insperity. It's important to note that a PEO is a medically underwritten product. So we do need to submit your census, dependent information to the carriers to obtain an approval. And when we compared the United Healthcare, the community rated plans for 20 employees, you can see that the master medical, the large group medical through these PEOs is between 50 to 60% less than the New York community rated plans. And it's not just the savings, right? But it's also the additional benefits, sorry, that you can provide through a PEO solution, inclusive of the long-term disability, life, voluntary benefits, employee assistance programs, and the list really goes on and on. And we wanted to finish with a real-life case study of an organization that we helped this year. They were spinning off of a very large company with thousands of employees in California. And the 34 employees that were spinning off and starting a new business were across 13 different states in the technology industry. When we spin off of a large organization, employees are used to that Fortune 100 level feel of having very rich benefits for dental, medical, vision, life, and then all of the additional benefits like EAP programs, pet insurance, fertility benefits. So we really needed to take a look at a PEO for this organization for, three main reasons. The first one is the multi-state compliance support. They were not going to have an internal HR person, so the PEO allowed them to outsource the HR through their services. And to Lori's earlier point, although this company was headquartered in California, more than 50% of their employees resided in different states. So they needed a national carrier and offering through the PEO solution, which the PEO was able to provide. On top of that, when there are spinoffs, everything needs to be done very, very quickly. So infrastructure, HR support, employee benefits were all stood up for the organization in a matter of 3 weeks, which is very, very difficult to do in a standalone situation. So, we want to thank you on behalf of Alliant and Sensiba for joining our presentation today. We hope it was impactful and valuable for all of you today. Here you have all of our contact information. Please feel free to reach out to any of us should you have questions on accounting, human resources, employee benefits, or PEO. We'll open up the chat for any questions.
Doesn't look like any questions have come through the chat. So, with that, we'll give you a few minutes back in your day. And thank you so much for listening and being with us. And we hope that it was beneficial. Thank you all.